Credit spreads are often simplified as compensation for default risk, but in real-world markets, spreads contain multiple layers of information: liquidity premiums, sentiment shocks, structural subordination, and expected recovery rates. In volatile macro environments, these components don't always move together, and understanding each one is essential for evaluating pricing signals in credit markets. Start with liquidity premiums. During stable markets, liquidity premiums remain narrow because dealers willingly intermediate trades. But when volatility spikes, dealers pull back. Regulatory constraints limit their balance sheet capacity, especially for lower-rated bonds. The result is that spreads widen, not because fundamentals have deteriorated, but because transactional liquidity evaporates. This is why high-yield and emerging market corporates often experience outsized spread moves during stress. Their liquidity premiums expand dramatically. Then there's distress pricing. Distressed bonds often trade at levels that imply extremely high default probabilities, levels that don't necessarily match fundamental deterioration. Markets tend to overshoot. Forced selling by ETFs, mutual funds, or CLOs, amplified by liquidity gaps, can push bonds far below their intrinsic recovery value. Understanding distress cycles requires looking at technical flows, not just issuer balance sheets. Recovery rates are another underappreciated dimension. Recovery isn't a static number. It varies by capital structure position, industry, and macro conditions. Secured bonds may recover 60 to 80%, unsecured could recover 20 to 40%, and subordinated or structurally disadvantaged debt may recover under 10%. This is why two bonds which are identical spreads can represent very different risk profiles. A bond with a 15% implied probability of default but a 70% expected recovery is fundamentally safer than a bond with a 10% default probability but a 10% recovery. Credit models that apply a blanket 40% recovery rate often misprice risk in sectors like retailers, telecoms, or energy, where asset values behave differently in downturns. Portfolio strategy also needs to consider rating migration. BBB-rated corporates close to downgrade can widen disproportionately as investors position ahead of potential fallen angel flows. Similarly, rising star candidates may tighten rapidly as they approach investment-grade eligibility. Finally, credit markets are heavily influenced by sentiment and macro uncertainty. Even without changes in fundamentals, fears about inflation, recession, or geopolitical shocks can widen spreads simply because risk appetite drops. Understanding how liquidity, recovery, and sentiment interact help investors avoid misinterpreting spread moves as purely fundamental signals. Credit spreads are multi-dimensional. They reflect more than default risk. They embody liquidity stress, recovery assumptions, structural subordination, and the psychology of markets under pressure. In volatile environments, knowing what each component is signaling gives investors and corporate leaders a significant advantage.